So we have been talking about financial statements. There are more financial statements, more than two, but we are limiting our discussion to talking about statement of profit or loss, and also the second one, which is statement of financial position. Now, I said that there are two keywords that we need to remember, that the statement of profit or loss gives us the financial performance of a business. By financial performance, we're talking about whether the business made a profit or a loss. That's the financial performance. So, in the statement of profit or loss, two things are compared: revenues and costs, revenues and expenses. So, all expenses are taken from revenue, and then if it is positive, if it's a surplus, it's a profit, and if it's a deficit, it represents a loss. So very, very important to remember this. And also, we started our discussion on statement of financial position. Whilst the statement of profit or loss is giving us the financial performance, the statement of financial position is giving us the financial position, the financial muscle, the financial strength. So it compares or it looks at assets and liabilities. It looks at assets and liabilities. So it gives us the value, the financial position gives us the value of the business. How much assets does it have? How much liability does it have? How much is the stake of the owners? That is the owner's equity or capital in the business. So we looked at these key financial um, position relationships, assets, liabilities. Remember, we said that your assets will be equal to your liabilities. That is, all your assets will be equal to your liability, yeah, your liabilities. And owner's equity is also a liability. It's not something the business owns. It is something that the business owes, and it owes owner's equity to the owners of the business. This is not this slide, this image is not in your textbook, but I just chipped it in here to further explain the relationship that all assets, which is your current assets and your non-current assets, will be equal to your liabilities, which is your current liabilities, your non-current liabilities, and then the contribution of the owners, which is the owner's equity. We stopped here last time on this diagram, which explains how profits are used. Some profits are distributed to the owners, which is called dividend. Some profits are kept in the business. We call these reserves. All right. So if a business is successful, it makes a profit. Some of the profits are distributed as dividends. Some of them are kept as reserves, which can be used to finance the purchase of assets for the business. And reserves represents increasing liability to the business, but also it represents increasing value to the shareholders, right? Because the reserves are for the shareholders. So we'll start from here, the format of the statement of financial position. But let me take us back a bit. When we looked at the format of the statement of profit or loss, we said that it is in vertical presentation. It's presented vertically. What does that mean? It means we start at the top. Some items are deducted. For instance, we deduct cost of sales from revenue, and then we get the gross profit, and then we deduct expenses, and then we get operating profit, and then we make allowance for interest paid, received, and also taxation, and that will give us the profit of the year. So this is a vertical presentation. It starts from the top and goes to the bottom. Now, the statement of financial position is also presented vertically. As a matter of fact, the law in the UK and in several parts of the world insists, IFRS, the International Financial Reporting Standards, insists that statements of financial position, just like the statements of profit or loss, are presented vertically. So you can see a vertical representation here. You can see the numbers starting from the top and then going to the bottom. So let's look at what is on it. So we start by listing the non-current assets. All right. The non-current assets are listed first. In fact, there is an order in which items on the statement of financial position must be listed. It says here that assets are listed in the order of liquidity. What does liquidity mean? Liquidity refers to how difficult it is to turn an asset into cash. So those that are most difficult are listed at the top, and the non-current assets are most difficult to convert into cash. What are non-current assets? These are assets that the business does not intend to resell. These are assets that the business intends to use for more than 1 year. All right. So we are talking about land, buildings, vehicles, and machinery, etc. It is difficult to sell these things compared to, or it is difficult to turn these things to cash compared to, say, cash itself or compared to inventory. So these assets are listed first. Non-current assets are listed first in the order of liquidity. And I've explained what liquidity is. The illiquid, those that are difficult to turn into cash, are listed first. So non-current assets comes first. And then we have current assets follow. So current assets are a bit more liquid than non-current assets. Current assets are more liquid than non-current assets. What does that mean? It means that the current assets are not as difficult to turn into cash compared to the non-current assets. All right. So we have our non-current assets, our current assets, and remember that non-current assets plus current assets will give us our total assets. All right. It's right here, captured here. Non-current assets or current assets plus non-current assets will give us our total assets. Then our current liabilities also follow. So our current liabilities also follow. So in this example, the non-current assets are 320 million pounds. The current assets are 165 million pounds. And the liabilities, which is in brackets, is a negative figure. So it is subtracted. All right. So current liabilities, also remember, minus current assets minus current liabilities will give us our working capital. I hope you remember that. Will give us our working capital, which is our net current assets. All right. So current assets minus current liabilities are working capital. It's a very important calculation on the balance sheet or on the statement of financial position because it tells us how liquid the business is. All right, so let's look at let's make sense out of it here. So we have 165 million in current assets. These current assets include our inventory, our cash, our receivables. Receivables are we sold and our clients or our customers are yet to pay. So we are expecting to receive the money from them. We call them receivables. It's included in our current assets. All right. So all these current assets, which are liquid, minus our current liabilities. So this our current liability is 85 million pounds. Those represents our short-term owings, the things that we owe to our client, to our suppliers, short-term loan that we have taken from the bank, etc. All right. So when we subtract our current assets from our current liabilities, it gives us our net current assets. It tells us how liquid we are, how much money we have to pay. If we pay all our liabilities, how much money we have left. All right. So it's a very important measure. Then followed by our non-current liabilities. These are liabilities that will span more than a year. So our long-term debts, all right, are non-current liabilities. It's also in a negative figure because some represents something that we owe, so that is subtracted. All right. So our total assets, which is an addition of our non-current assets and our current assets, minus our liabilities, which is an addition of our non-current liabilities and our current liabilities, will give us our net assets. So total assets minus total liabilities will give us our net assets. All right. And here on this statement of financial position is 270, which is also equal to the equity, which is 270. All right. So let's start from the top again. Non-current assets and our current assets. Addition of these two assets will give us our total assets. Then our current liabilities is subtracted. Current liabilities is subtracted from our current assets. That will give us our net current assets. Then our non-current liabilities are subtracted to get our net assets. So our net assets is the value of the business. If all the assets of the business is sold and all our liabilities are paid, this is what is left. Our net asset is what is left, and it represents the value of the owner's investments in the business. It represents will be um, how much will remain if all assets are sold and all liabilities are paid. This is what goes to our investors. So it says here the total equity is the money invested by the business's shareholders. All right. So just like I said, this statement of financial position is presented in vertical format. So it's presented in vertical format, and it is the most common way of presenting it. The second point down there says that all public companies in the United Kingdom are legally obliged to present their statement of financial position in the vertical format. All right, so memorize this. It's very important that you memorize the format of the statement of financial position and the statement of profit or loss. So this is an example. I took this example from the O-level textbook. You are in A-level. I took this example from the O-level textbook. So you can see that there's a statement of financial position for a company called Ace Machines Limited. And usually we would like to put 1 year by another year. So this is the previous year, 2017. This is the current year, 2018, so that we can look at the changes that have occurred from the previous year to the current year. So you can see that the non-current assets or the fixed assets are listed. Land, machinery are listed, and their values are given. It was 440 in 2017. It's 450 in 2018. That's the value of land. And then we have the value of machinery. And then followed by non-current assets are the current assets. So you can see inventory, accounts receivable. These are our debtors, clients who own us, customers who owe us, who have not yet paid. We are expecting to receive from them, so we call it receivables. And then we also have cash here. So remember that we are listing these assets in order of liquidity. The most liquid will be at the bottom. The least liquid or the illiquid will be at the top. So if we add our non-current assets and our current assets, we have our total assets, and then we can subtract our liabilities. We can see the current liabilities listed first. These are liabilities that will fall short. I mean, that fall due within 1 year. They must be paid within 1 year. So accounts payables, these are creditors, the people we owe, which we must pay before the next statement of financial position is drawn up in the next year. Bank overdrafts. Bank overdrafts are not long-term borrowings. They are short-term, and they need to be paid in under a year or before the next statement of financial position is drawn. And then followed by our current liabilities, we have our non-current liabilities. We have long-term bank loan. So the expression long term tells us that it is greater than 1 year, and it will take some time for the credit facility, the loan, to be paid off. And then if we add our non-current assets to our non-current liabilities to our current liabilities, will give us our total liabilities. All right, and then we have at the bottom here shareholders' equity, which is made up of what they have contributed via shareholders' funds, which is made up of their share capital. That's what they have contributed, and then the reserves, the profits which are undistributed, the reserves. All right, so straightforward stuff. Straightforward stuff. Let's look at our first case study for today. We'll go through it quickly, and then we will bring the lesson to an end. So the first one, the Mark and Spencer case study can be found on page 437 of our textbook. And for the purpose of um, anybody who might see our lesson later on the internet, there's a textbook that we are using by Hodder publication, Hodder Education. So let's look at our first case study on page. No, not this one, the Mark and Study one. I mean Mark and Spencer's one. So yeah, let's read. Marks and Spencer PLC Public Limited Company is a well-known retailer in the UK, very well known. It sells clothing, food, and household goods, such as furniture, through 1,463 stores and on its website. The table below, that's table 10.4, is a summarized consolidated statement of financial position. So across all of its stores, it's 1,463 stores. It has consolidated the value of all its assets and liabilities into one statement. And we have the 2019 figures, and then we have the 2020 figures. The statement of financial position for Mark and Spencer was prepared it's a snapshot. Remember, we said that the statement of financial position is a snapshot. So on which date are these values captured? On the 28th of March, 2020, and then the 30th of March. So this is the 30th of March, 2019, and then the 28th of March, 2020. So their non-current assets are listed. Then we have other. So no, the non-current assets are listed here, all right, which is yeah, it is not broken down for us. It just says non-current assets, all right. So we have the values here for 2020 and 2019, and then we have the current assets, which is inventory, receivables, and then other current assets. And when you add the non-current to the current assets, you have our total assets, which is here. So we have a total current asset here, and then the total asset, which is here. And then we have our trade payables. These are our current liabilities. So trade payables, remember, is different from the receivables. Trade payables are what we owe our creditors. So we are expected to pay. Receivables are what others owe to us. Payables is what we owe to our suppliers, our creditors. So we are expected to pay. And then we have other current liabilities. And then we have our total current liability, our non-current liability, and then our total liability, then our net assets. We know the formula for calculating all of these. And then we can look at our equity, which is our share capital, the contribution of our shareholders or our owners, and then reserves, the undistributed parts of our profit, and that gives us our total equity. Remember, we said that the balance sheet or the statement of financial position must balance. The statement of financial position must balance. So we can see that the total equity, which is the value, in fact, which is a net assets essentially, is equal to our net assets here, which is when all the liabilities are taken from the assets. It will give us the net assets. All right. What is the question? Question one. Question one says, calculate Marks and Spencer PLC's net current assets for 2019 and 2020. Calculate their net current assets. We know the formula already. This is the formula. Net current asset is equal to current assets minus current liabilities. So you may want to grab a calculator because you do the calculation and then we'll see whether you would get the answer correct. So net current asset is equal to current assets minus current liability. So take this balance sheet, take the statement of profits, statement of financial position, and calculate the net current assets for Mark and Spencer for 2019 and 2020. You know how to go about it, right?
Yes.
All right, so start. I'll give you some 5-10 minutes, and then when you get your answer, you let me know. I have the answer right here on the slide, so we'll just compare and see if you got it correct. Start work.
I'm doing question 1.
Yes, do
Only.
question one. Question one
Only.
only. Yes.
Okay.
Yeah, we'll answer question 2 together. Hello, Cheryl.
Yes, hello.
All right, so I have received your answers. So let's look at it. We
Okay.
know that the formula for net current asset is current assets minus current liabilities. Let me get my highlighter. Yeah, so we know that the formula is current assets, which is current assets minus current liabilities. So let's look at the statement of financial position that we have here. Let's start from 2019. So if we want current assets figure is already here, total current assets. It is 1,435.1. It is in millions of pounds, as we can see here. So the figure is actually 1,435,100,000 pounds. All right. So, or 100,000 pounds. So it is already here. Total assets figure or total current assets figure is already here. But when I look at your calculation, I see that you have current assets, you have inventories, trade receivables. You added all those things again for 2019. So you said inventories plus trade receivables plus cash. No need, no need. They already added it for you. There's a total current assets figure here. So there's no need to add it. All right. So you have to look at the statement very well. And also, we want total current liabilities. This is our figure for total current. This total current liabilities. The figure for total current liabilities is also here. So that's you got it correct. You got the figure for total current liabilities correct by adding your trade payables, the trade payables plus other current liabilities. So that's why it took you a long time. But already this 2,324, which you have here in your solution, is already here. All right. Same for 2020. The figure for total current assets is also here already, 1,215, which I see that you did not get right in your calculation for 2020. Your total current assets figure you did not get correct, but it's already here. And then the total liability for 2020 is also here, which you got correct. All right, so that will give you incorrect calculations because you had to calculate your total current assets for 2019 and 2020 again, but the figure is already on the balance sheet. Anytime I use the word balance sheet, please know that I'm referring to the statement of financial position. I'm old school, so I was taught that it's called a balance sheet. So let's look at this is what you should have. So your figure for current assets is 1,435, and then what current liabilities is 2,324. Let's go back and see if that's correct. Yeah, 1,000 435 is there, and then 2,342. So be careful. It's already, the information you needed to answer the question is already on the balance sheet. Is that okay? All right. So your answer must be this. It's a negative figure, so we put it in brackets. What does it mean? It means that the company has more liabilities than assets. Its liabilities here is in excess of 2.3 billion and its assets 1.4 billion. It owes people more money than it has. People that it needs to pay within a year, it owes them more money than it has in cash, uh, receivables, and inventory. All right. So it's not a very good picture for Marks and Spencer. It's a big company. You look at its balance sheet, its assets, its total assets. Let's look at its total assets. Its total assets is in billions of pounds, 8 billion for 2019. For 2020, 10 billion. However, it owes more people than it has in current liabilities. Its current liabilities is more than its current assets. However, it has a positive figure for net assets. That is, the net assets figure is positive. All right. So your calculation should look like this for 2019 and 2020. So your figure for liability is correct, but your figure for current asset is not correct. So you have to check it. All right. So let's look at question two. Let's look at question two. Question two, let's look at this better view. Question two says, evaluate the value of the information in this statement of financial position. Evaluate the value of the information in this statement of financial position to a bank, considering offering Mark and Spencer 250 million pounds loan. So Marks and Spencer wants to take more loans. Already it owes more people in current liabilities than it has in current assets, but it wants to take more loan, and we are asked to evaluate. Remember these keywords. What does it call it? Is it called a power words or something? Or active words? There's a terminology in your examination. I'll look it up and remind you what it says. Here we are just to calculate. So you calculate, you get your mark. That's all. But here it says we are to evaluate. So we have to look at the positive and the negative side. So let's find something negative about Marks and Spencer. Obviously, it has a negative working capital. It has a negative working capital both for 2019 and 2020. Its working capital is negative, and we know what that means. All right. So let's look at the suggested answer for question two. So the first thing that we can say is that it has net current liabilities. Its working capital in both years is negative. All right. So the statement indicates the ability of Mark Spencer to repay a large loan. This might worry the bank. The bank might be worried to some degree as Mark and Spencer has a negative working capital. It has net current liability. It doesn't have net current assets. Because the liabilities are more than the assets, it has net current liabilities. So it has a negative working capital, which indicates that its current liabilities are greater than its current assets. The bank may be concerned that the retailer may not have sufficient cash to make repayment for this large loan. So that's the first negative thing that we are looking at. All right. So we don't just look at the negative. Let's find something on the other hand to say. All right. However, the second point here for my suggested answer says that the statement also includes evaluation of the company's non-current assets, which is the point I made, that it has 8 billion in assets. It has 8 billion in assets. So a company that has 8 billion in assets and it wants to borrow only 250 million, you think it cannot do that? Of course it can. Because it has 8 billion in assets, the bank may be a little less worried because the company has security for the loan. If it's not able to pay the 250 million, they can just sell some of its assets and the bank will be good. All right. So that's a positive thing that we can see about the statement of financial position for Mark S. Spencer. It has a lot, its net asset here is 3 billion for 2020 and 2.4 billion for 2019. Its total assets is 10 billion for 2020, 8 billion for 2019. So that's a good thing. Although it has negative working capital, it has a positive net assets, and the bank may be able to grant the loan because they have security for the loan. And then the final thing that we can also say is a point I made in our last class, that we cannot um, analyze a business with only one statement, one financial statement. All right. We only have the balance sheet of Marks and Spencer. We only have the statement of financial position for Marks and Spencer. We don't have its statement of profit or loss. We don't know how much profit it is making. So we also need its statement of profit or loss to decide whether it is making a profit or a loss. It may have borrowed a little more, but it may also be very profitable, which will indicate that the business can pay for any credits that it takes. So the last point says that, however, the information in the statement is incomplete. It doesn't say anything about the revenues and the profits of the business. Remember, the statement of financial position presents just a snapshot of the business finances and not its financial history over the period. So we made that point that the statement of financial position will give us a snapshot of the assets and liabilities of the business at a particular date, on a particular date. But the statement of profit or loss will give us a history from January 1 to December 31st. How much revenue do we have? How much expenses have we paid? And then how much profit do we have at the end of the period? So this is how we can attempt to answer the question there. Any questions so far? And do you understand the points that I've just made?
Yes, I understand. No, I have no questions.
All right. Let's look at some of the things that will change the statement of financial position. Amending the statement of financial position. We did same when we looked at the statement of profit or loss. We look at some of the things that will change the statement of profit or loss. And we said that if revenue increases, let me bring back we looked at this. We said that some things will cause profits to rise. All right, some things will cause profits to rise. What are some of these things? When prices are increasing, when the sales volume is increasing, that's the quantity we are selling is increasing. And also our profits will rise when we lower our costs. When we have lower costs or when there's reduced taxation, to increase our profit. And some things will cause our profits to fall. These are the things that will cause an amendment to the statement of profit or loss. Also, in the statement of financial position, some things will cause amendments or changes in the statement of financial position. Let's look at these things. The first point on our slide says that when changes occur to the statement of financial position, it has a knock-on effect. What do we mean by a knock-on effect? It has actually a double effect. All right. So when one thing changes in the statement of financial position, it doesn't change that thing only, it has the ability to change another thing. So we would look at an example and we would understand more. How is it so? In an accounting class, we would be told about the double entry system, that every transaction that occurs in a business is entered two times in the records of the business. All right. Every transaction that occurs in a business is entered two times, and it's in accounting, it's called a double entry system. So when there is a change in one thing on the statement of financial position, it has a knock-on effect. It changes something else as well. All right. The second point says that the double entry system ensures that the statement of financial position always balances. So let me go back to this. Remember here we said that, no, not this, another one. Yeah, this one. Remember here we said that our assets will equal to our liabilities. And I also gave you this example. All right. So let's just say, for instance, cash increases. If our cash here is 2,000 and our um customers pay us. So we have accounts receivable here. It means that our customers owe us $1,000 here. If they pay us, it means that it will have two effects on our statement of financial position. The first effect is that if our customers pay us 1,000 that they owe, this is going to be zero. That's the first effect. And it's going to increase our cash to 3,000 because now they have paid us, our cash will increase. Is that okay? Here we can see that we have liabilities. Let's look at our short-term liabilities of 1,000, means we owe 1,000. If we pay this 1,000, this becomes zero and our cash will decrease from 2,000 to 1,000. All right, so there is a double effect. Because transactions are entered two times on the balance sheet or the statement of financial position, it affects one thing and it will have an effect on another thing. All right, so let's get back to our point. So the double entry system ensures that the statement of financial position always balances assets and liability. And I just gave you an example. So the following range of actions might affect a business's statement of financial position. Let's look at the first one. The purchase of a non-current asset. Let's say we buy a car. The purchase of a non-current asset, such as a machine or a car, as I said, would have the following effects. Number one, it can increase or it will increase the value of our non-current assets. It will increase the value of our non-current assets. If the value of our non-current assets on our statement of financial position is 15,000 and we buy a car which is 10,000, it's going to increase from 15,000 to 25,000 because of the value of the car, which is 10,000. What effect will it also have? Apart from increasing our non-current assets, it will decrease the value of our cash because we are using 10,000 to buy that car. All right. However, if we take a loan to buy the car, if we don't buy the car with cash, it means that it will increase our liabilities if we use a long-term loan to arrange the finance of that machine or that car. If we didn't take a loan, we are not using cash, and we are taking money from our owners, it will increase the value of our equity. So it is either this, the purchase of a non-current asset is either this, it will have this effect, or any one of these effects. Rather, to either increase or to have two effects, that is increase the value of our non-current assets or any one of these three. So that's the double effect that we were talking about in accounting, which we call the double entry system, a transaction having a knock-on effect, or when it changes one thing, it will change another thing on the balance sheet. So we are still looking at amending a statement of financial position or the things that cause changes in the statement of financial position. Let's look at the second example. If the business repays a long-term loan, if the business repays a long-term loan, it reduces the company's liabilities. So our non-current liabilities, which is our long-term loan, is going to reduce. If the business pays off a long-term loan, it will reduce the company's liabilities. What is the knock-on effect? What is the other effect that it will have? How did it pay that long-term loan? Did it issue shares to the shareholders to raise the additional, to pay off the loan? If that is the case, then it means that our equity is also going to increase. Our equity is also going to increase. So reducing the company's liability because we repaid a long-term loan would have an effect of issuing shares, increasing our equity. So it says selling additional shares to raise funds for loan repayment offsets the reduction in liability. So our equity is increasing here. Or we can sell an asset. Maybe we have a certain vehicle that we don't want. We have land that we don't need anymore. that we want to sell to repay our long-term loan. So that means that the value of our asset is going to reduce. The value of that non-current asset that we are selling, whether land or vehicle or machinery that we are selling, is also going to reduce. Is that okay? So here, an increase in shares, an increase in equity, and here a reduction in assets. We will talk about depreciation, which is the third thing here. We'll talk about depreciation as a topic on its own. But what is depreciation? Depreciation is when a business reduces the value of a non-current asset. The example I cited, if we buy a car, we bought the car for 10,000. The car after 2 years, after 3 years, will not have a value of 10,000. It will depreciate in value. The value of the car will go down. What is causing this depreciation? Perhaps wear and tear. It was brand new, the paint was brand new, it had that new car scent, but it doesn't have it anymore. The shocks are now weak. The car has been used, it has mileage on it. If you sell it to anyone, he's not going to pay 10,000 for it. The value is going to go down. So a business needs to reduce the value of its non-current assets from time to time. Only its non-current assets, and we'll explain why a business only depreciates the non-current assets. We'll talk about depreciation as a standalone topic. So the amending balance action is to reduce the value of reserves. When a business reduce the value of its non-current assets, when a business depreciates its non-current assets, the amending, the alternative transaction, the balancing or the knock-on effect is to reduce the value of the reserves. It doesn't reduce cash, mind you. When a business reduces the value of a car, for instance, if the car is 10,000 today, and we value it at 5,000 after 2 years, it will not reduce the cash in the business. The value reduction in the car, we have not sold it yet. We have not sold the car yet. Rather, we are even going to gain money when we sell the car for 5,000. However, when we reduce the value of a car from 10,000 to 5,000, it means that the value of our reserves will also reduce by 5,000. And then the last point here under amending statements of financial position says that a wide range of transactions will affect the statement of financial position, such as the sale of inventories or the use of an overdraft. So let's look at the sale of inventory first. The compensating amendment here may be a rise in the amount of cash. If we sell inventory, we are selling bottles of water, we are selling mobile phones, we are selling stationery, we are selling kitchen items. Once we make a sale, the value of our inventory will go down and our cash will rise. Our cash will rise. And then the use of an overdraft facility, what is the corresponding or compensating change here? The compensating change when we use an overdraft facility is that it says the compensating amendment here may be a rise in the amount of cash held in the company's bank account and a rise in current assets such as inventories. Yes, so a rise in current assets such as inventory when we use an overdraft facility to purchase that inventory. So it says, which may have been purchased using the overdraft facility. So when we go for an overdraft facility from our bank and we use the overdraft facility to purchase inventory, the value of our inventories will go up. The value of our short-term liabilities or our current liabilities will also go up. So we are looking at what's the things that causes changes in the statement of financial position, and we've looked at a few examples. The most important thing that you have to remember under this is that there will always be a knock-on effect when one thing changes on the statement of financial position. If assets are increasing, that means that something is also changing somewhere. If assets are increasing, how are the assets increasing? Well, what causes the assets to increase? How was it financed? It means that either we took a loan or we issued equity, we issued share, and this is what is causing our assets to increase. So there's always a knock-on effect on the statement of financial position when one thing changes. If our liabilities are changing, it is also affecting something else somewhere. It's very important to always remember that. Always remember that. All right. So the next thing is also another case study, but I don't want us to rush through this. We have already spent some time. I want us to take our time and look at this. So unfortunately, we would have to also spend more time concluding on the statement of financial position. We actually have just three slides more to go. This case study, then the answer. I will not ask you to answer it because it's a little tricky, and then yeah, further notes on this case study. That's the question two. All right, so we have just this case study to look at. So you can read the case study and then we'll answer it quickly. Maybe spend about 15 minutes on this before we talk about our next unit, which is the valuation of inventory, how to value inventory. All right, how to value inventory. Then after we talk about the valuation of inventory, we'll also talk about depreciation, and then we'll bring our first chapter to a close in accounting and finance. This is our outline once again. So when we talk about valuation of inventory and we talk about depreciation, we'll bring unit 10.1 to a close and we can start unit 10.2. So we'll do that on Saturday um, and then make progress. All right. Any questions so far?
No questions.
All right.